Rate of return and benchmarking. What they mean, why they matter, and how they're used. Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today's episode, we're talking about rate of return and benchmarking. Two kind of key concepts to a retirement portfolio and investing in general. And we'll just go over a high level of what they are, why they're important, and how they're used. And I think a great place to start is with the idea of if you're going to run a race, don't you want to know who you're running against and how well you're doing, right? And that's the whole idea here. You need to know, okay, how well am I doing? That's my rate of return. And then who am I competing against? That's the benchmark, right? If you just know how well you're doing, but you don't know how you compare to other similar people, maybe it's your age and, or whatever, if you're Division 1 or Division 2, if you can't compare to similar people, then how do you know if you're doing good or bad, right? You can know how you're doing against yourself, but you need that comparison, and that's the benchmarking. So benchmarking and rate of return are important things to know. Most people kind of understand them, but we'll take a little bit of a deeper dive. And so you kind of have a better understanding of what you're looking for or what you're communicating to with your advisor, right? If you're working with an advisor and they say, well, your portfolio returned 7% this year. It's like, okay, is that good? Is that bad? What are we comparing that to? Is that how we, set up our portfolio? Is that our target, rate of return that we were going for? Given the breakdown of stocks and bonds and whatever investments we have. So it's just important to, draw some comparison, draw some context to, how well are you doing and given what, your desired rate of return is and compared to whatever benchmark you're using. Okay, so let's start with rate of return, simple definition, okay? It's the gain or loss on an investment over a specific period expressed as a percentage. Really basic stuff, right? If you got a $10,000 investment, it grows to $11,000, your rate of return there is 10%, right? You gain 10%. Now, you got to peel back the onion and look at it a little further, right? There's a whole slew of different types of rate of returns. There's nominal versus real rate of return, which is before and after inflation, right? Are we factoring in inflation? Because we all know inflation eats away at our purchasing power over time. And so it's good to factor that in to the equation when you're looking at rate of return. It's not always necessary, but it's good to identify, what am I looking at here? Am I looking at nominal versus real rate of return? The other one is gross rate of return, right? We all know gross as a term in, taxes or finance, right? So that's just kind of your raw rate of return there. Then there's the net rate of return after fees, right? So, okay, let's say my portfolio returns 7% and I got the industry standard 1%, asset management fee. Okay, so now I'm at, a 6% rate of return, right? And it's just understanding, and then maybe there's other expenses involved, right? Especially when you're dealing with, various maybe REITs or something. There's more like administrative fees or other fees that kind of eat into, or trading fees, right? Maybe it's not just the expense ratios or the advisor's fees, but maybe there's trading fees each time you buy and sell. So just net of fees, what is your rate of return? And then there's net of taxes, if you want to take that extra step, because you got to factor in, let's say it's in a taxable brokerage account, and you have a 10% rate of return, but you're going to pay, maybe it's long-term capital gains tax, and you're at that 15% long-term capital gains tax. Then you got to figure out, okay, what was my gain net of taxes, right? Also, there's real rate of return, which again is just like the like we said earlier, there's nominal versus real, right? Before inflation, after inflation. Real rate of return, it shows the actual increase in your purchasing power. You got your total rate of return annualized, right? So you're going to look at it over, because that's the other thing with rate of return is what time frame are we looking at here? You can say, okay, this index, the S&P 500 returned this rate Okay, over what time period? If you're going to say, well, the S&P 500, is down 30%, over what time period? And then what are different time periods? Oh, it's actually up over this time period, 2 years, or it's just important to compare apples to apples when you're looking at your rate of return. People are quick to perk their ears up when they hear the percentage right away. Oh, it's 10%. S&P 500, 10%. Oh, wow. All right, 10%. What is that over, right? And what is that compared to? So you got to take time into consideration here. And then there's internal rate of return, which kind of takes into account like if there's multiple cash flows, like what's your rate of return if you're continually contributing or maybe taking distributions from an investment, and you got to factor that in to your rate of return over that period. So there's a lot of different rate of returns. It's important to dig a little deeper when you're just given a rate of return or you hear it on the business news channel. Say, okay, what rate of return are they referring to? Over what period? Is it net of inflation? Is it net of taxes? Is it, what exactly are they telling me? So now we know rate of return, how well you are doing, right? Now you can approach that question with a little more context. The second part is benchmarking. Okay, so now you figured out how well I'm doing, right? You know which rate of return you're looking at, and you kind of have a better understanding of what that is. Now, what are you going to compare that to? That's the next question. And that's benchmarking. So again, if you're running in the Honolulu Marathon here, I am 40 years old. I'm not going to compare my time to a 23-year-old. They should be outperforming me, right? What I'm going to compare myself to is other people in my age bracket. And that gives me a better understanding of how well I'm doing. So the same holds true for benchmarking. If you hold a fund with large cap stocks in there, then the S&P 500 is a great comparison, right? Because that holds a lot of U.S. large cap stocks. If you're comparing, your bond fund to the S&P 500, well, that doesn't make any sense. Why would you compare those two? Those are completely different things. If you're going to compare your bond fund, you got to compare it to, a popular bond fund index. And so what we'll do is we'll kind of go through here. I listed out some on my notes, just some of the most common indices for benchmarking, and we'll just kind of go through some of those so you have some context and understanding of where you can look to do some comparison. So in the U.S. stock market, these are super common. I'm sure all my listeners have heard of them, right? S&P 500, Dow Jones Industrial Average, NASDAQ Composite, Russell 2000. So let's real quickly break those down. S&P 500, like I said, 500 of the largest publicly traded U.S. companies. So this is one of the most common benchmarks you really hear is how well did the S&P 500 do? And it has your Apples, your Microsoft, your Amazons, all your big names in there, right? Great benchmark to look at, and that's why what I find interesting is you'll hear either in or you'll read in articles or you'll hear on the news, it outperformed the market. Okay, that's a very broad statement. What are you referring to when you say outperform the market? You have to assume they're talking about a total stock market index, right? And a lot of these big custodians, your Fidelities, your Vanguards, they have these total stock markets. But it's a very broad statement to say, well, it outperformed the market. Okay, the entire market as a whole, right? We're not even looking at just the S&P 500, even though that makes up a large part of the market. You got to look even bigger. Anyway, I digress there. So Dow Jones Industrial Average is... these are blue chip stocks. It's one of the oldest and most quoted indices. It's similar to the S&P 500. It's 30 large established U.S. companies. NASDAQ, that's heavy on tech and growth stocks. That's your Google and your Meta. There's 3,000 plus stocks listed on the NASDAQ exchange. But NASDAQ, most people just associate with tech. You got your Russell 2000. And the Russell 2000 is your small cap. and it's 2,000 small cap US companies. So again, this is a good gauge to use if you have a small cap fund, right? Let's say you have, some custodian small cap fund in your portfolio and you want to see, well, how well is it doing? You'd want to look up how well did the Russell 2000 do, and then you can see how well your fund is doing in compared to the 2000. My point that I'm trying to get across is you wouldn't want to compare your large cap or your S&P 500 fund to the Russell 2000. I mean, you could, right, for context to see, well, how well are small caps performing against large caps? But if you're just trying to see how well is my large cap fund performing against other large cap funds, then that doesn't do you very good, right? So same thing, international stock markets. You got the Nikkei 225, the 225 major companies listed on the Tokyo Stock Exchange. So let's say you wanted to get, heavily weighted in Japanese equities, you would compare yourself to the Nikkei 225 there. You got the MSCI EAFE. That's a mouthful there, but it's just large and mid-cap stocks in outside North America. So it excludes US and Canada, has a lot of Europe, Australia, and Asia, Far East kind of stuff. But there's all types of big indices here. Bond market, probably the most common one, maybe not the most common one, but one of the more common ones is the Bloomberg U.S. Aggregate Bond Index, AGG, and that's U.S. investment grade bonds. There's treasuries, corporate bonds, mortgage-backed bonds in there, and that's kind of like the main benchmark for the U.S. bond market. But again, it's just the point with understanding these benchmarking is to kind of know if somebody gives you a percentage of your rate of return, understand, what should I compare that to? And again, going back to my Honolulu Marathon analogy, I'm not going to compare myself to the 23-year-old. I need to know how well I'm doing against something that's similar to me, somebody in my same age group, right? That's what you're comparing it to. Now, you can use these, benchmarks to compare. Maybe you find that small cap stocks are outperforming large cap, and you're working with your advisor and they got this, they're telling you we got to go heavily weighted here. There is that too, but there's the kind of the tried and true famous line in finance of past performance is not indicative of future results, meaning just because you look at past performances of a benchmark doesn't mean that that's going to hold true moving forward. Unfortunately, despite what a lot of people will tell you, nobody knows what this market is going to do. You just don't, because there's too many variables. And what I mean by that is, you could do some real financial analysis on it and have a pretty good educated guess. But what you can't account for is a pandemic, is war, is, just name it, just whatever it is. There's unfortunately things that will always come into play that were unaccounted for, making it really hard to stay on top of and predict the market looking forward. We have best guesses though, and you still got to proceed with those educated best guesses, regardless of all the variables involved. So I think that wraps it up here. So rate of return, how you perform. Benchmarking shows you how you perform relative to others, right? And it's important to know this whether you're a do-it-yourself investor, just checking your own progress, or you're evaluating different fund managers that you want to invest in, or you want to evaluate, your financial advisor's returns. It's important to understand, okay, what period of time, what are we comparing it to, and what type of rate of return are we talking about here? And it's not always about chasing the highest rate of returns, right? I mean, if you have a portfolio in, let's say, the distribution phase of your life, right, in retirement, you're no longer chasing high returns. So you can't really, some people can, but what I mean by that is usually you're managing volatility at that point to manage distributions and income in retirement. You're no longer looking at your portfolio for growth. You're looking at it for sustainability and as a source of income through your retirement. And so you're going to be invested differently. So you shouldn't compare your portfolio in those instances to a portfolio of somebody who's young and, willing to take on a lot of volatility and risk in exchange for higher returns, right? So just know where you are, know where you stand, know who you're comparing yourself to, and know what your goals are. Know what your time horizons are, because that dictates a lot of this stuff too. There's a lot of free tools and tips out there. Everybody knows there's endless podcasts and content out there, some good, some bad. But there's a lot of free tools you can use and do the research yourself. Don't trust somebody. Don't trust me because you heard it here. Go do a little research, right? Look up Morningstar, Yahoo Finance, or whatever your custodian is. Dig a little bit. They have all this information available. You just got to kind of dig and find a trusted source to look at. So I think that about wraps it up. Just remember, rate of return, benchmark, dig a little deeper, peel back the onion, understand really what you're looking at there. In some exciting news, we have a potential guest coming on from University of Hawaii Shidler College of Business to come on, and I've been talking with him to do a little Q&A on private equity, kind of a private equity 101 to offer some insights and understanding there. So that should be exciting, and I'm looking forward to that. I don't know when that'll be, but that's in the works now. All right. If there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Katita and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Katita, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.